Hi and welcome to a new video with Athena Quant. Today, we're tackling a technique that's absolutely essential for any trader who has to follow the rules.
So, let's think about this for a second. You want the highest possible return, right? But you're constantly dealing with this maze of constraints. And that technique we're talking about, it's called linear programming.
These rules basically define your entire playing field. I mean, think about it. You might have a rule saying, hey, max 40% in any single stock, or you must stay fully invested at all times. Maybe you've got sector limits, like you can't have more than 30% in tech, or maybe you're long only, so no short selling. The list goes on.
So, how do you find the winning move within all these boundaries? That is the big question. Okay, so here's what we're going to cover. We'll start by really defining the tool itself, then we'll see it in action with a couple of real-world trading examples. And to finish up, we'll take a look at its strengths and its weaknesses. Let's dive in.
All right, section 1. What is linear programming? Well, the elegant solution to this whole constrained world we've been talking about is this powerful mathematical tool, linear programming, or LP.
I know. Optimizing a linear objective function, it sounds pretty dense, but don't worry. The core idea is actually super straightforward.
See, every LP problem really just has these three key parts. You've got an objective, which is the goal you're trying to hit, like maximizing your returns. Then you have your decision variables. These are the choices you get to make, like how much to invest in each stock. And finally, you have the constraints. These are just the rules you have to play by, like your budget or those position limits.
And this chart, it illustrates the whole concept brilliantly. We are choosing our portfolio weights, those are our decision variables, to maximize our returns, which is our objective, all while making sure we stick to our budget and position limits. Simple as that.
Now, what's really interesting here is how LP visualizes the problem. All those rules we talked about, they actually draw a boundary map, a shape that contains every single possible valid portfolio you could build. And this is the real magic of linear programming. It proves that you don't need to check every single point inside that shape. The best answer will always be found at one of the corners. It's a huge shortcut to finding the perfect solution.
Okay, let's move on to our first big application and see how this helps us build a portfolio in the real world, how we get from rules to returns.
Okay, so imagine we have $100,000 to invest in, let's say, 3 stocks, each with a different expected return. LP takes our rules, like the max 40% and min 10% per stock, and it finds the exact allocation that gives us the highest possible return. And there's the answer. LP instantly tells us to put 40% into stock C, 40% into stock A, and the last 20% into stock B. No guesswork, no gut feelings, just the optimal allocation.
Okay, great. Now let's apply LP to another huge problem in trading, executing a large order without scaring the market away.
So the goal here is to execute a massive 100,000 share order over, say, 10 time periods. But we have a critical rule. We have to stay below 15% of the market's volume at all times. The whole key here is to blend in. We want our trading schedule to match the market's natural rhythm. And that rhythm is often U-shaped. It's high at the open and close, and pretty low in the middle.
And this is what a typical day's volume looks like. So, how do we schedule our 100,000 shares to follow that same pattern? Well, LP calculates the optimal schedule for us. It tells us to trade more shares when the market is active and less when it's quiet, which minimizes our footprint. At the end of the day, we're just using math to trade smarter.
LP is without a doubt incredibly powerful, but it's not the right tool for every single job. So let's dig into where it really shines and where it falls short.
So the key difference here is that LP is designed for linear goals, like maximizing return. But other methods, like quadratic programming, or QP, are built to handle nonlinear goals, like, for instance, minimizing your portfolio's risk.
And this is really where LP is king. Anytime your problem involves a linear goal and a set of linear rules, think enforcing position limits, optimizing trade schedules, minimizing transaction costs, LP is absolutely your go-to tool. But it definitely has its limits. Because it's linear, it can't directly manage concepts like risk, which is quadratic. If you want to require a whole number of shares, for example, you'd need something else, like integer programming. For risk, you need a different tool.
So we've seen that linear programming provides the provably best answer within a given set of rules, which leaves us with a final thought. How do we balance this kind of mathematical perfection with the human judgment and intuition that's so crucial in trading. Thank you so much for watching.